Super investors are investors with more than $100 million in assets under management. Now, luckily for us, these investors are required to publicly display the changes in their portfolio every quarter, giving us a great insight into their investments. Now, over the past weeks, I've noticed one stock that super investors such as Richard Pzena or Dodge and Fox are buying. And these are all investment trusts with more than $1 billion in assets. The company these investors are buying might be considered boring, but very often it is the boring companies that generate the highest returns. And the company I'm talking about is CVS. On the 1st of May, CVS dropped by 17.1% due to its 2024 first quarter earnings report, which gave a great opportunity to buy the company at a discount. Now, since the large drop in price about 3 months ago, the company has been doing quite well, currently trading at $63.18. And so what we will do today is jump over to my stock valuation spreadsheet and figure out the intrinsic value of CVS and understand whether it is a good opportunity to buy the company at its current trading price. So we will plug in the ticker CVS and wait for all the metrics to show up. Now, right away, we can see that CVS is a dividend company. They currently pay out a dividend yield of 4.21% with a dividend payout of $2.66 and a trailing free cash flow payout ratio sitting at only 23.68%, which is very nice, showing that CVS does have enough free cash flow to buy back shares or pay down debt, which are two very important things free cash flow is used for. Now, of course, if you do enjoy these spreadsheets, if you find them helpful, you can always access them at my Patreon in the link in the description. Now, we can see that the earnings date of CVS is at August 7th, which is only about a week's time from now, so there might be another opportunity to buy the company at a very high discount price. Now, we will jump to our 9-pill analysis and have a look at the historical data of CVS. So right away we can see that the 5-year PE ratio is on average sitting at 15.35, meaning that CVS has been trading at a discount price over the past 5 years on average. If we scroll down to the graphs, we can see that the trend line is indeed decreasing, meaning that the PE ratio of CVS is going down over the past 5 years, which is fabulous. Now, scrolling back up, we can see that CVS has been growing their revenue as well as their net income. Their free cash flow has been decreasing by about 2.5% every single year. So that is something we can have a look at. If we scroll down to the free cash flow graph, we can see that indeed the free cash flow has decreased from about 13.5 billion in 2019 to only 8 billion in 2023. Now, this shouldn't be too big of an issue as long as the company has enough free cash flow to pay off their long-term liabilities while paying out their current dividend. And so having a look at the long-term liabilities over the 5-year free cash flow negative dividends metric, it is currently sitting at about 2 for CVS, which means that the company can pay off their long-term liabilities while paying out their current dividend in about 10 years. So I'm not too worried about their free cash flow decreasing. Though if we have a look at the consecutive dividend growth, we can see that that is sitting at about 10% every single year. So if we scroll down to the quarterly dividend, we can indeed see that it has been increasing quite steadily over the past 5 years. Now, one issue I have with that is that when the quarterly dividend increases but the free cash flow decreases, the company is essentially paying a higher percentage of their free cash flow out, meaning that their free cash flow payout ratio will go higher every single year unless their free cash flow starts increasing again. So overall, we can see that the company has been doing quite well over the past 5 years and should be set to do quite well in the next few years, though we do have to keep a lookout for its free cash flow. But now let's try calculating its intrinsic value. So first we will jump to my Grams formula revised. Here we will plug in the earnings per share, the base PE sitting at 7, the 5-year growth estimate sitting at 10.39, the growth rate multiplier, average yield on A corporation bonds, and the current yield on A corporation bonds, and we will get an intrinsic value of $119.02, which is about 47% higher than the current trading price. showing us that based on the earnings per share, CVS is indeed undervalued. But let's jump to our second valuation model, which is based on the free cash flow of CVS. So we will plug in the free cash flow over the past 5 years and calculate the average growth rate to be sitting at negative 10.5%. And we can also see the analyst growth rate projections over the next 5 years sitting at a positive 5%. So I will calculate a growth rate of about 2% based on the research I did in the back end, which is something you should always do before buying into a company. Now, plugging in our calculated growth rate over the next 10 years or so, we will calculate the future free cash flow over the next 10 years, including the terminal value. Now, to calculate the present value of that future free cash flow, which is the future free cash flow accounting for inflation, we have to calculate the discount rate. Now, I like to base the discount rate on the WACC of the company, but adjust it based on the risk that comes with investing into that one specific company. So essentially, the more risk I take investing into a company, the higher the discount rate. So I will plug in the discount rate for CVS at 7.5, and we can see that the intrinsic value for the company goes down slightly by about $12. Now, summing up the future free cash flow, adding cash and cash equivalents, subtracting total debt, we get an equity value which we divide by the shares outstanding and get the intrinsic value sitting at $78.12, which is about $15 higher than the current trading price. Now we can move to the multiples valuation, and here we will compare CVS to its competitors, in other words CI, UNH, CNC and HUM. Now we can see that UNH is quite a big outlier with its PE ratio sitting at 38, which raises our intrinsic value by quite a bit. So what I do in these situations is remove the outliers, as it is always better to undershoot than overshoot with the multiples valuation. Now to get the intrinsic value, we'll take the stock prices of the companies and we'll divide by their earnings per share to get their PE ratios. We'll then average out the PE ratio and multiply by the earnings per share of CVS and get the intrinsic value to be sitting at $130.43, more than 100% higher than the current trading price, showing us that CVS is indeed undervalued compared to companies which operate in the same sector. But now let's move to our final valuation model, which is the dividend discount model. And here we'll take the dividend payout over the past 5 years and calculate the average growth rate to be sitting at 9.45%. Now I will project a growth rate of about only 6%, as we saw in the 9-pillar analysis. I do believe that if the company doesn't start increasing their free cash flow, they will have to lower their dividend growth to keep their free cash flow payout ratio low and be able to pay off their long-term liabilities, buy back shares, pay out dividends, and overall expand the company. So getting back to our dividend discount model, we will project a growth rate of 6% into the future, and we will get the next year's dividend to be sitting at $2.76. Now, as our WACC is lower than the projected growth rate, our dividend discount model doesn't work due to the math inside it, and therefore we have our alternative model, which takes the next year's dividend, the stock price next year projected by analysts, and the WACC of the company, and gives us an intrinsic value of $75.57. Now let's jump to our ultimate valuation, and here we will average out the 4 models we just did and get an intrinsic value of $100.78, which is about 60% higher than the current trading price of the company. Now, if we plug in a margin of safety of, say, 25%, we'll still get an acceptable buy price at $75.59. And with that, if you did find this valuation helpful, make sure to check out my Patreon in the link in the description, where you can download these sheets for your own personal use. Also, make sure to let me know down in the comments which company you'd like me to evaluate next, and leave a like and subscribe if you'd like to see more of such videos.